picture and sound at this point. See my mouse moving around? Yay. Good, cool. Right on time. Amazing. All right. Oh God. Greg, can't we find a computer to read this or something? All right. It throws me off having a short week. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders are discussed and tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstarkworld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar website or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read the characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Fantastic. I feel good about that. All right. Let's see. Oh, I know what I didn't do. I didn't turn off the microphones. I always forget that. Mute the mic.
You are now muted.
Now you guys can all chat and make noises in your living rooms, wherever you are. Okay. What is going on today? We've got the Fed in an hour. Fed in minutes, not a meeting, so not really an actual big deal, but, you know, obviously they'll get big reactions either way. The market's perking up. Mostly the market's perking up, though, because if we go to Seeking Alpha, there we go. And if we go down to right about when the markets turned up, which was like 11:30, right after Europe. So not only did Europe close, but see what Tarullo said. This is not an economy that's running hot. And he said this in some Wall Street Journal. There's an actual, a big thing. So he says it right to the journal. He wants to see inflation not just moving back to 2%, but evidence it'll stay there. So in other words, inflation has to go to 2%. Then it has to last at 2% for more than at least one meeting, obviously. So you're just pushing and pushing and pushing out this thing. And don't forget Japan. Japan has been trying to get to 2% inflation for 20 years. Okay? They may never raise rates if that's going to be their benchmark. Okay? And frankly, they can't. We've talked about this before. They can't raise rates. Because we are $19 trillion in debt. So if you raise rates 1%, we have to take $190 billion and use it to pay interest. That's on the debt we already have. And that is, what do we have, a $4 trillion budget. So, well, it's not so much we have a $4 trillion budget, it's that we have a $1 trillion discretionary budget. So essentially, it's like 20% of our discretionary budget would go to pay interest on debt. And that means that all these programs, the only good programs, I mean, look, most of our budget goes to Social Security and Medicare and defense. That's where $3 trillion goes. Leaves $1 trillion for having a park, or for building a road, or for teaching your child how to read, or for testing to make sure that these companies aren't killing you with their chemicals and so on and so forth. So all those annoying government regulatory functions are part of the discretionary budget. Essentially all the things that make life livable are discretionary. So those are only $1 trillion. If everything else is mandatory, you can't cut it. I mean, you can cut defense theoretically, but good luck. So if all those things are mandatory and you can't cut them, then if you have to suddenly come up with $200 billion more to pay your debt, not pay your debt, to pay your interest on your debt, it comes out of discretionary. And you have to either raise taxes, again, good luck with that, or cut debt. Meanwhile, I hope you guys saw that video from Bill Maher. It was really good at the end of today's post. I had a video from Bill Maher where he basically talks about that. He's like, look, we've had this experiment, okay? You had Kansas not raise taxes, and they fell into a total, complete disaster. Meanwhile, California raised taxes considerably, especially on the top 1%, raised taxes on corporations, and they completely turned their economy around. They're not just the biggest economy in America statewide. They are the 5th biggest economy on the planet Earth. Their GDP, the GDP of California, puts them ahead of England in GDP. So it's not a small test. It's not like you go, oh, it's just one state. No, it's not just one state. And Bill Maher makes the point. You know what happened? The Democrats took over the governorship. They took over the House. They took over the Senate. They took over all the legislative offices. California is completely 100% run by Democrats, putting in the Democratic agenda, and it's fixed. That's essentially where we are in California. Their budget is fixed. And it only took a couple of years of Democratic plans put into action to get there. From what they were saying was a complete and utter disaster. So all this stuff can be fixed by just raising taxes on the wealthy and raising taxes on corporations who pay ridiculously low amounts of taxes. Corporate tax rate is effectively 12%. Okay, they pay an effective tax rate of 12% on taxes. Although, you'll hear Trump saying, oh my God, we have a 35% corporate tax rate. Nobody pays it. They deduct and deduct and deduct, and they roll their losses forward, and they do special write-offs, and they do these tax swaps out of things. So yeah, on the tiny amount of taxes you can catch them on, they pay 35%. Apple pays 35%, but they keep half their money overseas, so they're effectively paying 17% or less. You got companies like GE paid zero. GE made $12 billion and somehow got a refund. I mean, they're freaking brilliant. Okay, they're geniuses. But is that right? Is that help? Is it destroying America? Anyway, so back to these guys. So Tarullo, the PCE index has risen from 1.6 from 1.3, but this could be due to oil prices have stopped falling rather than underlying. Actually, oil hasn't stopped falling. It's back to falling. But we'll see. It's back to 47.50 at the moment, and actually almost makes a trade. Anyway. So things are kind of crazy, but this, at 11:40, there were two things that happened. European markets closed, and Tarullo, at the same time, said that everything was going to be good and they weren't going to raise rates. So what happens? Oh, how do I get this? Oh, wait, can I just unpin from the taskbar? Yes, go away. There. Maybe now I won't do that anymore. Here's my real one. This morning we called along on the Nikkei. Unfortunately, missed that here at 15,250. That was our first play in the morning, and that's been going very nicely. Now we're at 15.4. We also took the EWJs long this morning. That was another trade we liked. I'm sorry, we're going to look at the timing of this. The timing was actually 10:30, 10:50 basically. We started popping 10:50. I don't know when Tarullo made the comment that seeking alpha picked up at 11:40. Actually, let's see. Wait. So we started turning around. We bottomed out here 10:10, 10:20, and by 10:30 we were turning up. And Europe closes at 11:30, and we get the other pop, right? So let's see what happened. Let's look at the Wall Street Journal. They're probably, since it was their conference, we'll find out what time he said it, right? Go to the Wall Street Journal, and we'll look for Tarullo, Tarull. Oh, there he is. Okay, Tarullo. Hello. Ah, great. Fed's Tarullo, blah, blah, blah. This is not an economy. So here's where the article is quoted from. Aha. See, 10:06. And that's how the Fed moves the market. So this article was printed at 10:06, and it says all the crap that's seeking out to summarize. It's all in here. So basically, they were just late with the summary, so you can't go by that time. But that's when it happened. So at 10:06, the Wall Street Journal prints it, and you can see the effect. You can see the effect as it came. So here's 10:06 is when the article came in. In fact, look at that. There was actually a spike up at 10:06. So some people started buying right off that article, some computer program or something. Because you see a spike like that, it's probably a computer. See the volume spike and the spike up? But then it faded because people were in the process of selling and saying, well, what the hell? You know, they didn't see this news. Go down a bit more, but by 10:30, everybody heard it. And up and up and up and up and up we go, and all of a sudden we're in the green for the day. Amazing. It's a good turnaround, too. We bottomed out at 17.6-ish, and now we're at 17.8. So 200-point flip in the Dow on that. Now, when you have a move like that, and the reasoning is essentially the same bullshit the Fed keeps saying, we know they're not raising rates. That's not news. So you got to look at what the gains are and say, well, at what point is this overdone? All right, so we look over. So here's the NASDAQ. So I'm immediately going to wonder if Apple agrees with the NASDAQ. That's the right chart. Yeah. My other thing has more charts. Apple. So does Apple agree with the NASDAQ? Well, Apple is up half a point. The NASDAQ is up half a point. So yeah, I that's a clean move on the NASDAQ. All right, so everybody basically made a little half a point move up, and it's like an across the board reaction. What Tarullo said. So, you know, you have to think like, well, okay, it's a pop, but we're just popping back to where we were yesterday, basically, and now the question is, why would this really make us sustainably higher? So we have to just watch the action. We're kind of neutral right now. We don't care. And in fact, more to the point, let's take a look at that. Well, hang on, let's see if we have any questions first. Not only does California have the most progressive income tax rates of all states, individuals begin paying a 6% rate of $27,000. It's now surpassed Hawaii. Yeah, and meanwhile, did everybody leave the state? Did people move out en masse? Did all the rich people flee? No. In fact, Phil Maher made a great point. He's like, here, Nebraska has the lowest tax rates. The lowest state tax rate, and he showed a picture of Nebraska, like an outhouse, like in the middle of nothing. And he showed the beach in California. He goes, look, who's leaving this for that? Who's actually going to leave California? You know, you're there for a reason. You live in the state for a reason. And okay, yeah, there could be a point at which they raise taxes where people do say, okay, screw this, I'm going to wherever. Again, I'm on my way. I'm going to San Diego in a couple of weeks, actually. I don't know where you go from San Diego. I go all over the world. I travel a lot. I mean, frankly, when I get that hotel, I get the hotel on the beach in San Diego, and you know, my brother lives more in town, but screw that. I'm staying on the beach. So I get the beach hotel in San Diego. I walk along the water. I get my tacos and things like that, and my breakfast burrito. I mean, I don't know. You can't really go anywhere else. Okay, I go to Florida. It's not as nice. It just isn't, you know, and I go to the LA beaches, they're not as nice. I mean, it's just certain places, you know, that are better than other places. And it's not like it would take a lot more than like a small rise in my income tax for me to run away and move out of state and give up all that. You know, usually you live in a state for a certain reason. And, you know, taxes, yeah, it's a consideration, but it's not your primary consideration. And also, you got to realize your state needs to be supported, otherwise the whole state collapses anyway. You know, I guess also another reason though is because I think liberals understand that, and they accept the fact that the state needs money, so we're all going to kick in 5% and save the state. maybe conservatives might leave the state if they raise taxes. I mean, frankly, if Nebraska raised taxes, everybody would leave because now you have absolutely no reason to live there. The official wall of debt vastly understated the magnitude of state debt. The wall is $443 billion of state debt. That's a lot. We'll see. Texas is no pigment either. Anyway, on to whatever. Okay, so the point being here, I would not be inclined to play this rally. It's already gone. You know, if you didn't play the bounce, you missed it. Too bad. You know, that's that. As I said, we played the Nikkei because, frankly, the Nikkei was lagging. It was slow to move, and I like this line at 15, whatever it was, at 15,250. It was a good, solid line. So once we got over it, I thought it was good for a run. But now we're done with it. It's over. That was a nice move, and that's that. All right, we still have the EWJs long. There was no reason to change that bet, but those are longer term. This is a short-term play. Picked up the quick money and all good. Now also notice you have still a declining line going this way. So frankly, this is a good test. If we get over that, then things have maybe changed. But otherwise, we have this declining thing here that's actually not bullish until we pop over that line. Now, these guys, better shape. All the U.S. indexes are in better shape. The NASDAQ move is very encouraging, but it's probably the NASDAQ. So you have to realize the NASDAQ is a wacky index. It only has 100 stocks, and they're very heavily weighted. So I don't know what particular stock on the NASDAQ would be doing really good right now, but if you look at it, you might see like it's just really one or two stocks that are pushing the NASDAQ higher. Oil made a recovery, and gasoline, I imagine, is probably doing better. Where is that? Oh, right there. And gasoline made a bit of a recovery, but nothing exciting here. Natural gas back over 275. That was a good line to play north, actually. The dollar down a little bit, but nothing exciting there. Gold topped out at 1977. That's huge. 1377, sorry. And silver topped out at 2050. Of course, it got rejected at 2050. All right, yeah, I mean, you see at 2050, you got to know automatically you're going to hit trouble at 2050, and especially if it then is also one of these resistance lines. That's going to cause a tip. Copper is still really lame. I mean, copper is just 215 for copper is like there's just no industrial demand. It's a really weird situation. You know, and look, in fact, I mentioned very important point. I was saying to my brother, who doesn't have the ability to hedge his portfolios, you know, his larger portfolios he keeps with a couple of brokers like Morgan Stanley or whoever. So he doesn't have the ability to hedge it in those accounts, and because they're IRA, and or hedge it conveniently. He's always on about like he's with a broker, and apparently like the guy doesn't return his calls, But you know he's not really managing his own account. Like they manage his account. He has a little bit of input, but generally they manage your account. And he makes generally, you know, they generally come in around 10% a year, and he's pretty happy with that, especially after he got whacked in 2008. So he's really happy to have a conservative 10% a year for a large bunch of his money. But I just said to him, I said, look, you've got to go to half cash. You can't have an unhedged portfolio that's bullish in this market because, God forbid, we have a 10, 15% drop. And then you blew 2 years' worth of gains. I said, what's the point? And I wouldn't be saying that if the S&P were at 2,000, but we're not at 2,000. We're at 2,088. 2,100 is a line that we automatically short the S&P. And we will keep automatically shorting the S&P until it proves that it can hold 2,100 for more than a day or two. So there's relatively little upside from here. And if you're not going to sell when things are up here, when are you going to sell? Only when you panic after it drops 10% to 1,800, then you're going to say, oh, or 1,900. So 1,900, you're going to suddenly go, oh, I guess I better start selling now. I need cash. That's not the time to get cash. The time to get cash is when you're near the top. So you got to be relentless and go through your positions and see where you are with everything and check it out. and make sure every single stock. Don't look at your position and say, do I like them or not? It's the question is, if this stock drops 20%, do I want to be in it? And if the answer is no, get out now while it didn't drop 20%. That's all there is to it. You think about the worst case and you get out. And maybe you'll regret it, maybe you'll say, oh, I could have made another 10%. So what? Just get out. Take the cash. There'll be plenty of things to buy. Would I be considering RBCL right now? No, I don't have any reason to play the energy stocks. I haven't seen any particular news that makes me want to play them. I haven't seen any particular levels that they're proving a support. You got to wait until it shows you something. I mean, you can't immediately jump in. I mean, look, energy, okay. Days, good, okay. So, 46 was a line you could have played for a bounce, right, on WTI. 145, okay, we didn't hold 145. Well, here, that's a good point. We didn't hold 145. 140 is a good line. And you could have sat there and played that if we tested 140 and it came back. Okay, so 140 is a good support line because when you back up on 140, you say, ooh, look at that. It's been support since April. That makes it a good risk-reward to play. You play the 140 line with tight stops. And what would have happened if you played the 140 line with tight stops? You don't play when you could play here, but you would stop out. Then when it crosses back over, you get in and play it. And what would you have gone to? You go all the way up to 142.50, where you should know that you're going to get rejected at 142.50. Then it comes back down, back near 140. There you can take a chance if it slows down enough at 140. Comes back up. No reason to stop out yet, and you have a good trade. That's how you play those things. You got to look back at least to the daily level and see where your support is. So, that was gasoline, sorry. So for crude, again, you got to go to the daily, zoom out, and if you're not satisfied that you have a good position there, you go to weekly. This doesn't tell us anything. Those two bunchy. So we look at the 45 line. Say, was the 45 line good support? Well, yeah, it actually held above 45. It's actually the 46 line here. 46, 46, 46. 45 held here. So, yeah, I take a poke at 46. I would take a poke at 45 with tight stops below each one. But if we fail that, where's the next support? Is 44 support? Not really. Is 42.50 support? 42.50 is barely a support line. 40 is the real support once you fail 45. But is there any reason I think oil should be heading back to its highs? No. Don't see any. Well, what am I expecting to happen that oil should be back at its highs? So it's not playable. I don't have a good reason. I don't have a good range. I don't have anything that supports it. This line is playable. But now that it's here, it's not playable. I got it, because this is, here's your range. Your range is 50 to 46, right? And it's lasted from this entire period, since June 20th. 50 to 46 is your range. So when you're at 46, go long. When you're at 50, go short. When you're in the middle, don't play. Unless you have some specific thing that makes you say, I think we're going back to the top of our range. Don't have it. You don't force a trade. You find a reason to make a trade. If you stare at the same damn screen all day, you're always going to be saying, oh, there's a trade, there's a trade. Oh, I missed that. That's bullshit. Okay? This is fine. You can set an alert for 46. You can set an alert for 50. Those tell you what to do. But I frankly, I wasn't even looking at oil today. I could care less, and it's just not interesting right now. What's interesting is whether or not the market actually holds. Going the same way, I want to look at the S&P. I want to see what the hell the S&P does. Here's 2100. That's where we go short. Here's 1850. That's where we go long. In between, I don't really care. Here's my Nikkei. 15,000. We like going long at 15,000. We didn't get to 15,000, so I called an audible at 15,250 because we couldn't get down to 15,000. All right, now we made a little bump, and that's what I was looking for, a little bump, and now we'll see what happens. All right, if we get back over 15.5, I might want to go long again. If we go down, though, I'll be very happy to go long again at 15,000. That's one I'm interested in because, frankly, if the Bank of Japan does do something and we happen to be long when they do it, we can go back to 18,000 and this thing will make $10,000 per contract. That's the kind of trade I like to be in. Oil, maybe I'll make a few hundred, maybe I'll lose a few hundred. This one I can make $10,000. I like making $10,000. That makes me real happy. What did I want to talk about? Oh, the portfolios, yes. Now let's look at our portfolios. And this morning, I'm going to be doing this a lot right now because we're not sure if we're balanced properly, so we're going to check our balances. So let's see how we're doing. I will be as surprised as you are because I haven't done this yet. Log in. Okay, portfolios. And we've got the OOP, 63.1%. So that's 163,142. Here. So 163,142, and we were at 162. So we're basically up $600 today on a little bit of an up day. So basically, apparently what this is telling us is we're still kind of bullish, or at least it's telling us that we're short-term bullish, because you have to look at what your protections are. And our hedges in the options opportunity portfolio are this SQQQ, which is September, that's a long-term hedge. We have August TZA, long-term hedge. Is that it? No. And then we have the October TZA, also a long hedge. All right? So we have some actually very long, we have generally long-term hedges. The only thing this portfolio is really protecting is if the market goes down more than 5% and stays down over the summer. That's our hedging. So we're still generally bullish in this portfolio. We don't have a short-term hedge. We didn't put back, well, we do. We have this August TZA. And so we're obviously, this is going to expire worthless, and we're going to have the naked August 40 calls over the course of next week. If we feel the market is weak over the course of next week, we will not add we won't turn this into a bull call spread. But if we think the market still looks strong into next week, we're going to sell the August calls too and just make this a cheap insurance play. But this is money we expect to lose if everything else holds up okay. All right, so our junk bond thing not doing well because the bonds are staying up. Our TLT is a disaster, wherever that is. Our TLT hedge is, look, $3,000 down on TLT, because less the 800, so whatever, 2,000 at least, is down because it's totally wrong. Look at TLT at 142. Freaking insane. We've got September 137s. We're going to, if we want to stay in this trade, they're at 187 now. We're going to really have to roll these up and sell something else to pay for it. But these 138 puts, the short puts, no, not the short puts, sorry. Oh, yeah. I mean, these will expire worthless because we're way over 138 and we've only got a week left. And then we'll see what happens. But I mean, basically, it's a bad trade. It's not working. End of story. Now, UNG, we're stuck in that, but it's, it's well in the money. We're happy with that one. UCO, we are also, this will expire 100% in the money, so we're not worried about that. All right, so this portfolio is fine. It's just, unfortunately, though, it has a very big fluctuation rate. Just the way it's set up and the way it's hedged, it's going to have a big fluctuation. So in other words, if the market does go down, the fact that you've got this bull call spread as a hedge means that the net of the spread isn't going to change very much. Even though this guy's in the money, and in other words, if he goes more in the money, you can get from 18 to 23, $5 is $10,000. You have $10,000. You can go $10,000 in the money, and you'll barely see a difference between the net. Right now, it's even showing a net loss. So we can go 5,000 more in the money, and you'll barely see 10,000 more. Go 10,000 more in the money, you'll barely see a difference on the spread. The spread is great protection, by the way. So, I mean, how could it not be great protection? The 17.23 spread is net not even a dollar. I'm sorry, not even a dollar. It's $1.30. So $1.30 for a spread that's $1.10 in the money. And you have protection all the way out till September, and you can get $5 more back. And you're getting almost 5-to-1 protection, 4-to-1 protection, let's call it. And it's in the money now. So the only way you don't make money is if the S&P is over 2050. Anything under 2050, you're going to make money. And as much as 4 times back. This is a great hedge. I think maybe we should double that. We should probably get more of those. And then I think yesterday we did the top trade alert on SDS spread, of course. All right, so anyway. So this portfolio is short-term bullish and long-term neutral. It's not bearish at all. Okay, so we're not bearish on this portfolio. We need to get much more bearish if the levels don't hold up in the indexes. But so far, they're holding up. We haven't even fell below 2050, really. 2035 on the big chart. Thank you, Jean-Luc. Okay, so 2035 is a 10% upline on the S&P. So unless we start failing these, unless we go 10% down here, or unless 4,400 on the NASDAQ fails, that's a flashing danger. But unless the Dow fails 17.6 or the NASDAQ below 4,400, and one of these guys is below, and this is holding 2035, we're not going to be really bearish. This has to at least fail 2035 before we say, oh, we need to be more bearish. Because so far, the S&P's been holding everything up all the time. And here it is, like, look, here's 2035 line right here. Holding. Brief Brexit panic, but it held. And that's it. So why am I going to get more bearish when this has been all we've needed so far, and it's a 5% correction? It's actually 2.5% correction from here, from 2070. All right, so that's that portfolio. So you always, and this is the thing, you've always got to review your portfolio, think about where you are, and think about how it's affecting day by day. So what was our other portfolios? We've got the butterfly portfolio. Now that thing is all over the place because we sell a huge amount of premium. So the money floats around a lot. So that's at $260,000, and it was this morning at 263. Oh, really? So we lost another $4,000 on this one, but it always has, the butterfly portfolio always posts a bad intraday number because the spreads tend to widen intraday, and you get some pretty negative things. We got Valero. Then you say, well, why am I losing money, or what particular thing is hurting us the most? It's not this one, gold. This is so far in the money, it's a pointless, it's just a dead trade. Not dead like that, but dead like there's nothing to do but wait for it to pay us off. Disney, the January 80 calls are what? That's interesting to me. All right. So these calls are down 17. Oh, these calls are down 17. These are up 17. So that's a nothing. So where's that real loss? Here. Target. We have short puts on Target, July. Oh, and there were 77.50 puts. I see. And Target's way down. So we have these puts that we're going to have to roll along. That's one of our big losses. We have Texas Instruments, which is too high, and we'll have to roll that along. And we have Valero. These are our calls that we own that have lost a lot of value, but we don't really care if our calls lost value. But the weird thing is that the calls lost way more value. Our calls lost money and our puts lost money. Doesn't matter which way you bet Valero, you lose money. That's what they're telling us. But that's fine. But meanwhile, look, as long as we're collecting, when did we sell these? We sold these on 6/16, It's not even, so by July 15th, we're up $1,000. So if these plays have 18 months and lost $9,000, and these plays in 1 month made $1,000, and actually that's in the money, so even this money would come to us too. It's $2,000. So if we make $2,000 a month selling and we lose $9,000 in 18 months, who cares? Okay, that's not a problem. It's just something we need to catch up on that trade. And here's a biggie too: the Walmart short calls. Well, that's silly. See, again, this is why this portfolio, you got to be careful about looking at your numbers, because we own the 65s. We gained 11,000 there. We lost 8,000 on those, and we're making money on the short puts. There's no problem there. That's a fine trade. So, look, fluctuations are what they are. But with a butterfly portfolio, you kind of have to ignore the daily movements on. And just, look, every month it grinds out some cash. That's all we care about. Short-term portfolio. Now, we do expect the short-term portfolio is bearish. So we probably gave back the $5,000 we gained yesterday because the market popped back up. So let's see what actually happened. 406. 5067, and we're at 506. Oh, nope, same. So actually up $700. So the short-term portfolio not as bearish as we would think, but pretty well mixed. That's okay. And the long-term portfolio, now here should be the star of the day, because the long-term portfolio, since we bounced back a bit, nope, no change there either. It's at 1005, and it was at, no, it actually lost $10,000. Interesting. Oh, no, sorry, not 10,000, 2,000. My mistake. So the long-term portfolio lost a couple of $1,000, and the short-term portfolio, I got my days mixed up. And the short-term portfolio did lose a little bit of ground on the way up. All right, so we lost a little bit of ground on both of these guys. And again, that's what we want to do on a day when the market is green. If we're generally bearish and we want to be positioned bearish, I expect to lose a little bit of money when the market's green. So as it stands now, we're positioned correctly for our expectations, which is the market goes lower from here. Now, if the market doesn't go lower from here, we're going to have to start adding some more bullish positions. That's all. All right, so hopefully that was clear, and let's see what people are saying. What do you think about utility stocks in this market? I don't like utility stocks because there's a weird thing going on with utilities. I mean, not telcos. I like AT&T, I like Verizon, but not if they're high in the channel. I like them when they're low. Utilities, like electric utilities, whatever. First of all, the ones that have to use natural gas are going to pay more for natural gas because natural gas is going up. The ones that use coal have to switch to natural gas. That costs money. Nuclear, making no progress whatsoever. Then the other big issue with natural gas, though, it's the same problem the gasoline companies have right now, is that more and more people are converting to solar. It's a big trend. And everyone who converts to solar, and especially buildings, if you notice, I mean, if you do, I do business, I go to a lot of meetings in different office buildings. And it's really surprising how many people have gone solar in their office buildings. And they're very proud of themselves. They have these little screens when you walk in and tell you how much they're saving, blah, blah, blah. It's nice. But you think about that and you say, well, geez, the electric company is losing these customers. And they lose customers, and theoretically, since they're regulated, every time they lose a customer, they should be raising the rates to all their other customers to make up for the lost customer, because they still have the same operating costs. There's not that much change in their operating costs, whether, with how much electricity they put out. And even worse, some of these people are selling their electricity, their solar electricity to the ports and the power companies buy it. And I'm saying this is a bad thing. I'm saying it's a bad thing from the point of view of a power company. Frankly, I love it. This is what we've always dreamed. This is what a liberal environmentalist always dreamed of. But the transitional phase right now for the utility companies is they are going to have to keep going back and keep begging for rate increases to offset the lost customers as they lose people to solar. It's kind of like the cord cutting thing, right, for cable. Everyone talks about cord cutting and how it's hurting things. And that's one of the reasons Disney had a weak stock, is because people are not buying ESPN, and there's a lack, and then all the cable companies have little problems getting more users and so on and so forth. And somebody just downgraded Netflix today, in fact. So, I mean, Netflix is actually what you cut your cord for, but still, it's just the growth of all this stuff is slowing down tremendously. So, for the utility companies, they're constantly, for years to come, are constantly going to have to go back and back and back to their regulators and say, we need an increase. We have to charge more per kilowatt because now we have 1/3 as many customers. Now we have, 10%, 20% less customers than we used to have. So how can we charge the same to customers who we have? And not only that, but the customers they have are using these freaking LED light bulbs and LED displays that use half as much energy. You realize all these flat panels that you have on your computers, right? They use 1/10 as much electricity as your old computer screen. It's a very passive way that you've been saving power, and every office in America is doing that. And your flat TVs use less power. And every time you put in those LED lights, they use less power. We have LED lights in my kitchen. We never turn them off because they're like, we leave them on because that's so downstairs. It lights up. The whole downstairs is lit up by those lights. We don't turn them off. They don't cost anything to run. They literally, they cost less money to run those constantly, and they don't ever wear out. They cost less money to run these things constantly than it used to cost us to turn the kitchen lights on and off. So, all these little passive savings that are going on are great for the consumers, but they're terrible for these utility companies. So no, I don't like utility companies. That's why we don't have any in our portfolios. They're not a bargain. They're actually just, their business model is dying. It'll take a very long time to die, but their business model is dying over time. One day, and not only that, but then 10 years from now, 10 years from now, Lockheed Martin is promising us fusion. Imagine that. then these guys are totally obsolete. I mean, remember Back to the Future, you had that little Mr. Fusion, it's called. We're a long way from that. But they're talking about fusion. They're not talking about massive-sized plants. They're talking about fusion like basically the size of a truck. A fusion reactor the size of a truck that can power your whole town. And all you got to do is keep throwing garbage into it. So it solves your town's garbage problem and powers your town. So what happens to your utility company then? And the funny thing is and here's the problem with the utility companies. They don't have the mindset. Same problem with oil companies. They don't have the mindset. The oil companies should have invested in replacement fuels 20 years ago. They should have been planning for the end of oil. Instead, they fought it. And they spent millions and millions of dollars lobbying to stop people from moving to alternative fuels and to keep fossil fuels as the number one source. They lost the fight, and now they've got all the wrong bets. And it's the same thing with utility companies now. They should be embracing the future, and they should be the ones putting solar panels in everyone's home. Doing what Solar City's doing, which is they're giving you free panels, and a lot of these companies do that. They give you free solar panels. They pay for everything, do the installation, but you sign a contract saying, I will pay you what I would have paid my utility company, or maybe a little bit less of a discount. I will pay you that much money for 20 years to pay off the panels. That's what their business model is, basically. They steal the electric company's revenue stream by giving you the panels, and then the panels get paid off plus their profits over 20 years. It's a leasing game. That's what it is. But the utility companies could do that, and frankly, I trust them a lot more. If my utility company came by, because they have a relationship with me, a business relationship, and they said, look, we're going to have cleaner energy, and we're going to do this and that for you, and we're going to share the benefits of the discount with you. So first of all, we're going to be able to stabilize your rates going forward. We're going to not have to raise your prices, and we'll even be able to give you a discount. And based on your usage and based on your savings, we'll actually be able to say, here, we're 50-50 splitting the savings with you, and we're doing all this for free. I would be sure And they're also going to say to you, and of course, we're going to always keep the grid active, so if anything ever happens to your solar system, you'll immediately flip to our electricity and never have to worry about it. What a pitch, right? Who wouldn't do that? But they don't. They let their business get stolen because they think that it's one or the other. They can't logically get their head around like why they should be doing both. They don't want to transition the world away from electricity. But they need to. It has to be done. Not really away from electricity, but away from that model, the old model of generating electricity. How do I like TLT does? So please don't even ask me about TLT. That's a stupid thing. No, I don't. I have to say I almost want to pull the plug on the one we have because always do this. Where's the thing? Chart. Here we go. Look, part of the reason I was writing what I wrote this morning is because I'm getting my head around that. Somebody made a good comment yesterday, and they were saying, look, it's not about what kind of idiot is taking a U.S. bond to 1.3%. It's that a 1.3% U.S. bond is 2.3% better than a European bond. That's why that's why we're shooting up. We're shooting up because our rates are the best rates in the world. For a AAA rated bond, I think we're still AAA. For a AAA rated bond, we are paying way more interest than any other country with a AAA rating, even a AA rating. So money is pouring into our bonds because of the relative investment. It's better. In fact, frankly, if you borrow $1 trillion from Japan at -1%, so they pay you 1% to borrow money, if you can get that rate, obviously you can't unless you're a bank. But if you're a bank, you do get that rate. But you borrow $1 trillion from Japan, you buy $1 trillion worth of U.S. bonds that pay you 1.3%, and also they're in dollars. Even better, you get rid of the stupid yen, you convert them to dollars, and now you have nice, good, strong U.S. dollars versus a yen that the Bank of Japan wants to make weaker if possible at all. So you have a bank in Japan that's trying to make the yen as weak as possible. You owe 1 trillion yen. You pay them back when you cash in your dollars, and if you're lucky, aside from the fact that you've got a 2% plus differential in what you're borrowing versus what you're collecting on the other end, if the dollar is stronger than the yen when you pay back, you're going to pay back a lot less yen than you had originally. Your $1 trillion will buy a lot more yen, and that means you will keep a lot more money. So all kinds of people are playing those spreads. But the key to playing that spread, though, is you've got to buy U.S. bonds. So whether the bond itself is an insane instrument, unfortunately, that's no longer in play. And that was my mistake, because I should have really thought of that when we started taking these TLT plays. I wasn't thinking really. I was thinking TLT on its own, and that this line here shouldn't be broken. But the paradigm has shifted, and the negative rates in other parts of the world, which is almost everywhere else in the world now, are now making it so that we are the best looking bonds on the market. And since the Brexit, which is here, since the Brexit, everything popped. Here we exploded up, and money is just flying into this country as a safety net. So I think hopefully 142.50, and we'll get at least a retrace back to 140. But if we get to 140 and we can get out anything close to even, I will be thrilled. Because I'm kind of done with this trade. There's not, as long as everybody else is keeping these crazy low rates, I don't see why we're going to. Oh, when's the Fed? Oh, 10 more minutes. Okay, we'll watch out for that. Any thoughts on Harmony? I like Harmony. I've always liked Harmony. They're like one of my top. Okay, I like ABX, I like Harmony, and I like NIKKEI. Those are my three mines. Conservative ABX. I love ABX as a permanent part of my portfolio. Okay, and as you can see, nice, steady, up, 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 very good. They went down from 15 to 6. I love them here. I like them here too. I always like them. I liked them here. I loved them here. Now they're back up in the 20s. That's fine. They're probably going to go to 30. Harmony is riskier, more speculative, but I like the whole South African mining story. Jesus Christ. I mean, under $1 was crazy. Now they're up here. They're probably going to be good for they should be at least 5, but they're getting close to 5. Again, it's just a good solid miner, and I like him, but unfortunately, this is a huge run. But just like ABX, slow and steady, moving up, and they're probably still underpriced at 425. NIKKEI, I don't think it's really had a big move yet, but NIKKEI is a complete gamble. But they are sitting on one of the largest gold deposits in the world. They don't have the right to mine it. They can't get the environmental regulations passed because Alaska's freaking out that they're going to destroy the rivers, where all the waterways and things. There's not enough water, and the mine is going to pollute it, and they don't have a good enough plan to isolate the mine from their disgusting runoff. And basically, it's a waiting game. So NIKKEI needs to stay alive long enough for a new regulator to come in and say, hey, okay, we're going to let you do it. So that's where that stands. But if they ever do get it, they will go flying higher. So it's a fun speculative thing. It's kind of thing you buy, what are they, 35 cents? So you buy 1,000 shares for 35 bucks. Is that right? 35. 10 would be $350. 100 would be $35. Sorry, and then 1,000 would be $350. So you buy 1,000 shares for $350, and if all goes well, you'll get $2,000 back when they pop. You'll get $2 a share back. So it's that kind of speculation, but it could be years, and they may go bankrupt in between. That's the thing. So nothing you'd want to put a lot of money on. But it could be like a 10 times move if they ever get past it. Audio issues, okay. Yes, no. By the same logic of money flowing into TLC, couldn't just flow into equities as well. Well, it is. No, that is what's happening. Money is flowing into equities, and that's why the equities are so high, and that's why people are willing to pay PE multiples that are higher than they were before the last crash. Because where the hell is he going to put your money? And I said that to my brother too today, because he's got a decent amount of money put away, and I said to him, what do you need? And, he's happy getting 10%, and that's his sort of dividend payments and so on and so forth. And he's older, he's 60, so he's already 60, so he's looking more like towards retirement stuff. So the thing is, in equities, it's like, yeah, you want to get your dividends, you want to get your returns, but he made 10%. Those dividend stocks of his, this is what I said to him about cash. He made 10% on his dividend stocks this year, on the equity side, not the dividend part himself. And I said, well, don't you think that's too much? And he's like, well, yeah, in a normal year, if they go up 2 or 3%, I'm thrilled. And I'm like, yeah, well, it's too much. Money is flowing in, exactly what's happening. If people, to get an AT&T paying you 5% dividend, when you put money into the Bank of Japan, they take your money away. They charge you for holding your money. So of course I'd rather put my money into AT&T, but it's already happened, and that's why money's going into these stocks, and it's pushing them too high. They're not justifying the returns. So how long could it last? It could last a long time. Because we said the same thing in 1999. I would have said, no, it's frickin' Yahoo. They do this and they do that, and there's no way they worth $200, right? No, I would have said that at $100. I mean, I did say that, frankly. People say, what do you think of Yahoo at $100? I'm like, I wouldn't buy Yahoo for $100. That's insane. It's like 1,000 times earnings. Then they go to 200. And they say, well, how about now do you like Yahoo? I was like, no, I don't like Yahoo. 2,000 times earnings. Goes to freaking $300 a share. 3,000, I think they chopped out like 3,500 times earnings. The earnings never changed. Just the buzz changed. And finally, at 3,500 times earnings, they went back down to 100. They went back down to 100 so fast, nobody even got a chance to get out. And then they fell down, down, down. Well, they now 10. They were 10 at some point. So people who held them long term got wiped out. People who were smart and took money off the table when they got to silly prices made money. So I was right. They were never worth 100. But I was wrong because they went way past it. So there's no way you can tell for sure when this stuff is going to stop or when it's going to change. But there will be, at some point, you got to just play, no. You can be a momentum trader. I'm not a momentum trader. I'm a fundamental value trader. So I stop playing. I cash out when something gets too expensive. I don't care if it goes higher. I'm not playing that game. It's a different game. Okay? It's like if you're playing baseball, and you got a bat in your hand, okay, and you swing, and you say, if that was a football, I could have got a touchdown. It's not the same game. Don't look at the game the same way. If you want to play that kind of game, that's fine. Go with the momentum and watch for your fund flows to dry up and look at where the money's going and pay attention to those numbers. I go to the value play. But my values changed on TLT specifically because the information has now changed, okay? I'm looking at the world situation a little more broadly, and I'm looking at TLT in context of everything else in the world that you can put your money into bond-wise, and I'm saying, you know what? Okay, I guess I'm wrong. It's not too expensive because everything else is so ridiculous. It's less ridiculous than other things that are ridiculous. Standalone? No, I don't like it, okay? But compared to the other things, I can understand why other people do. So that's one thing. I mean, that's the problem with a lot of investors. Everybody says, it's absolute. You play the game you're playing. Monopoly rules don't apply. The game of Monopoly, the rules don't apply to baseball. The baseball rules don't apply to the game of Monopoly. Football rules don't apply to baseball. Basketball rules don't apply to football. It's not wrong. The guy playing basketball isn't wrong. Michael Jordan isn't wrong, and John Elway is right. They're playing a different game. And they need to know the rules of their game, and they need to be good at their game. In fact, Michael Jordan tried to play baseball, and he sucked at it. He didn't suck, but he was, obviously not good enough to make the majors. So, you have to know what you're doing and how you're playing. And so if I say, I don't like this or I don't want to play that, that doesn't mean you don't have to play it. You're not playing the same game. Make sure you know what you're playing before you before you get into like what should and shouldn't be done. I'm talking about fundamental investing. I'm talking about long-term investing and building a portfolio over time. I'm not talking about day trading. So when this stuff happens, that is outlying events that you're going to look back and say, remember that time that the S&P went up to whatever, or remember the time TLT hit 145? It's an outlier. So let's take a look. TLT, 10 years. Here you go. Here you go. So here we were here. TLT generally 100, blah, 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 right? All of a sudden, it goes up and up between October 08 and January 09. If you short it here, you're wrong. If you short 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 here, you're right. But from 95 to 120, which is a huge move, 25 points, like 30% move, then you get blown out of the water. Now, it doesn't mean the person who said here that TLT is not worth 100 was wrong. It's the same as my Yahoo example, right? You weren't wrong when you said it wasn't worth 100. You were just wrong with your timing. So a momentum trader does well. But if I'm with conviction trading and I'm going to short at 100 and then it goes, what the hell is that? If I'm conviction trading and I'm going to short at 100 and I'm going to double down at 110 and I'm going to double down again at 120, when it goes back to 100, I'm going to make more money than you do with your trade. Because I'm 4x by the time it gets up here. I say if I have conviction, stick with it. The problem I have right now at 142 is I don't know where the top is. We've been playing it with conviction. When it went up past 130 something, we started playing it with conviction. I'm not sure if my conviction is holding because of the negative rates in other countries. So it depends. It depends what the Bank of Japan does. I don't think they can lower rates any further. I think they'll do another kind of stimulus. I don't think they're going to lower rates anymore. And if they don't lower rates, then this TLT thing will look good. Not only that, though, but I think this Brexit panic is what's responsible for this, and that's going to fade out. And hopefully we'll get back to 130. And our TLT trade, which is why it's still on the table, because I am sort of back and forth about it right now still. So our TLT trade is, we have the September 137 puts. So the net of this trade, $3 here and $1.30 credit, and what's this? Oh, these are dead. Okay, so we lost 2 here. So it's $5.10 minus $1.30 is $4.80, $3.80. So we have $3.80 net in the September 137 puts. So that means our break even is about 133. So the question I have to think about when I look at the chart is, do I think TLT between now and September will calm down back to 133? September's a long time, and I'm not ready to say it's a loss yet. But I'm not also willing, though, to double down and do anything drastic right now. I want to see what happens up here. I want to see if it's going to finally stop. Because in the past, it has been very dangerous to try to call a top to this thing. Stan says, I would like to increase precious metal miners. I don't want to chase. Would you expect a retrace soon, and what would trigger it? The dollar. Yeah, I agree. I think metal. We talked about metals today in chat. I think that the dollar is going to run up to 100 again. Let's take a look at the dollar chart. Not that one. This one. Dollar. Here we go. So, first of all, these guys don't want their yen over 1 here. They don't want the yen this high. They will do something drastic to stop this from happening. What's drastic? They want to weaken the yen, therefore they will strengthen the dollar, strengthen the euro. They'll buy euros, buy dollars, print more yen. Very simple to debase your currency. You print money, doesn't exist, you run it off a printing press, you give that money to these guys and these guys in exchange for their money. So you create a demand for their money without creating demand for your money, because you're giving away money. There's no demand because you're making the money up. So you're not causing demand on the current supply of yen. You're just making money and creating a demand for dollars and euros. That's how you debase your currency. And now there's more yen floating around and less dollars and euros floating around because you're sucking up the supply. Now, Japan has been doing this over and over again. It doesn't work. And the reason it doesn't work, and I've explained this before, so I'm just going to do a real quick thing. The problem is in reserve currencies. Let's see if we have something here. Let's see if Wikipedia's got things. Reserve currencies. Whoops. Reserve currency. Wikipedia. Great. Okay. This is great. Freaking Wikipedia is the best. Everyone should give them money, by the way. They ask for money once in a while. Make sure you give them money. Because if it wasn't for Wikipedia, we would have no facts. The U.S. dollar is 63% of all the currency in the world. The euro is 22%. The yen is 4%. Okay? Now, here's what happens. Here's why Japan can't get the yen to stay down. And by the way, there's no other Asian currency here. There are francs, there are Canadian dollars, there's Aussie dollars, but there's insignificant numbers, but still, there's Swiss francs. All right? Oh, I'm sorry, there's not French francs anymore. There's Swiss francs. The German marks and French francs are gone. So you have pounds, Canadian dollars, Aussie dollars, Swiss francs. Those are your choices. Those are, and then there's other little, this includes Zimbabwe money and things nobody actually wants. So when you're diversifying your holdings, when you're a billionaire and you've got $500 million of liquid cash sitting around, okay, your financial guy says, well, we don't want to put it all in U.S. banks. We have to diversify our currencies a little bit, at least something. So you say, okay, all right, let's keep. Now, Americans do this more so than other countries. In other countries, they're much more even with the diversification. Americans tend to hold 50, 60, 70% of their money in their local currency. But even if they do that, let's say you're only doling out 30% of your dollars to another currency, right? Here's the thing. We're richer than all these people. So we have more proportional dollars anyway. We are then allocating 30% of our money, and again, it only matters what the top 1% does. It doesn't matter what you do, okay, because they've got all the money, effectively. You've seen those charts, too. They've got all the money, so it doesn't matter what you do with your money. What matters is what they do with their huge amount of money. So we're taking our money, and we're doling out 30, 40% to other countries. And what are we doling out to? Usually it's going to be euros, some Swiss francs, and maybe, I really counted. I wouldn't put money in, it would never occur to me to put money in pounds. You put money in Swiss francs, you put money in euros, and you put money in yen. And when you're putting some money in yen, out of your 30%, you're going to put 10% into yen. But you shouldn't, right? Because the yen only represents 3.9% of all the money. You're completely over-allocating to yen. Now, European traders tend to be, European wealthy people tend to be different. They tend to allocate maybe 40, 50% to their own, and they'll put 20% in dollars and 20% in yen, because to them it's the same thing. It's two sides of the ocean. That's how people think about it. Now, the worst of Japan, though, is the Asian investors, because every other Asian currency is scary except the yen. And frankly, the yen is the most terrifying of all, but they don't see it that way. Think about the Chinese government. Think about trusting Hong Kong to hold your money. Think about trusting mainland China to hold your money. Think about trusting Indonesia. India. It's all like, it's like if you're a person in one of those countries, you want a lot of your money in yen. So for them, the yen is local money, relatively local money, and they put a large amount of their money into yen. So a guy who's a billionaire in Asia will keep less than 30% in their own currency, and they'll put 70% of their money into other currencies, and they'll split it between the yen and the euro and the dollar. But they over-allocate to the yen also because, again, they want to have their money at some reasonable, like in a bank that's close in a currency that's easy to convert in Asia and so on and so forth. This is why money is constantly flowing into Japan. They can't stop it. No matter what they try to do to their currency, more and more money comes their way. And it's insane. And the country is so ridiculously in debt, 250% of their GDP in debt. It's a complete train wreck, but people still put money into it. Not only put money into it, but put money into it. They don't care negative returns. They just want to have their money diversified into something. And Japan to them looks like a stable government compared to the other government choices they have. And that goes for us too. When we put our money into Asia, I'm not putting my money in a Chinese bank. Are you crazy? That would be insane. So that's what happens. That's why Japan can't keep the yen down. So anyway, so all they can do is at some point the Central Bank of Japan has to take actions on a regular basis to debase their currency. And they have to force it. This is a breaking point for them. They have to do something. They can't let it get much higher than this. It's getting out of control. So they'll take an action. So anyway, the end result of that is that the dollar will probably take a trip back to 100. And not just for that reason, also because we expect some trouble in China over the summer, and there's other obviously pockets of instability. So more and more money will flow into America. That creates a demand for dollars, and up we go. Also, our economy is better than other people's economies for the most part, and up we go. So for many reasons, the dollar is probably going to get 4% stronger. That will in turn knock down metals. Now, usually they'll go down double what the dollar goes up, so you're talking about an 8% decline in metals, but that doesn't mean they're done going up. It's only going to knock, let's say 10% off where they are. So let's say gold should keep going to 1,400 at least. And even if it goes to 1,500, it's still going to pull back 10% from there. So that brings it right back to 1,350. And silver, the same thing. So basically, where they are now is where they'll probably pull back to. So I wouldn't buy anything now because I would want to see them pull back first, and I'd buy them on the way down. And even though on the way down, at least I'll get better prices for selling puts on the way down, and maybe it'll go lower. Maybe that correction will happen sooner. I don't know. But I believe that even if gold does go to 1,500, naturally it should pop back at least 5 or 10%. So that means there's no real reason to chase it long 1,370 because we're already too close. So it's really just a patience thing. Look at platinum. Platinum's going to hit 1,100, and it's going to get rejected there too. And it's just a function of rejection. I mean, of course you're going to get rejected at major resistance like that. That's perfectly normal. Silver got rejected at 21. When you start hitting numbers like that, surprised me to get popped. We didn't get popped at 20. That was weird. But that's because of Brexit. We popped over and kept going. But all this is Brexit. So you're already up almost 10%. The 1,400 line is 10% up on Brexit. It's really not a good enough reason to be up 10%. But obviously, if your currency looks like this, then damn straight you're going to buy some gold, right? And look at poor English people. Where are they? Over here. I mean, obviously you're going to buy gold. You got to do something. And by the way, do you realize what gold looks like priced in pounds? Oh, here, wait. Let's see if we can do that. The next thing on stock charts. So we say GLD colon, actually we can do gold. Star gold priced in XEU. I think that's euros. There you go. So that's the move from here. So basically, here's the Brexit from 11 to 12.25. That's the move priced in Europe. If we look at gold just priced in dollars, see, not as pronounced, from 12.75 to 13.50. So what's that? 75 divided by 1275 is 5.8%. Well, clearly it was more the other way. And then if we price it in euros, XEU, so now we've got 11 to 12. Oh, you know that's a lot more. So that's 1.25 divided by 1.2. It's 10%. So it's double. All right. So gold's move to a European who has euros, or is double what it is to us. So you think it's impressive. You think this is impressive looking. What? Wrong thing. You think that's impressive looking. It looks like double that to a European. So yeah, that's why there's a gold buying frenzy, because gold is flying from their perspective, and they better get freaking on board before it falls apart. We have a strong currency. Now, to Japanese, because the yen has really popped also, because the yen has popped, that's tempered gold's move. So if we do the same thing with XJY, yes. Oh, I'm so good. I can't believe I remember these things. Now, look at gold and yen. It barely moved. They're like, well, no, Brexit. If you ask a Japanese person, they're like, no, Brexit really had no effect on gold. So a Japanese investor is looking at gold and being like, yeah, not a very exciting investment for Japan. It hasn't hit them yet. They start debasing their currency, though, gold's going to fly, and you have another group of people who say, I better get into some gold because it's flying. From our perspective, you see 13.6, so you'd add $1.36 here, so you'd be at 14.20. So if you're European, that's the gap. From here to here is the gap in perception. If you're American, from 14 to here is the gap. So that's something you always have to realize also. From different countries have a different perspective on the same commodities that you're looking at. So their currency changes, our currency changes. It's usually not this drastic, but this is a crazy time. And again, this is why we're not really doing anything. I'm very happy to park the portfolios in neutral and just watch things happen, because as we watch it happen, we'll get a clearer picture of what's going on. But sometimes you see something and you see this move in gold, and that's really from your perspective. It's not from everybody's perspective. Okay, there's no Japanese brokers telling people that gold is blasting up. There's no Japanese chart priced in yen that's showing some incredible move in gold. Now, if I was in Japan doing Philip Sung's Stock World over in Japan, I would then be telling people, think about this. We're the only country that doesn't see a huge move in gold. We should be buying gold because there's going to be probably a bigger move. That we're undervaluing gold in Japan. And I would be right. Now, by the way, that's not because I think gold's going higher. It's that I think the yen will go lower, because that's going to happen. Either gold goes higher or the yen goes lower. But either way, I think there's a good chance of winning if you buy your gold in yen. Now, you could set that up as a paired trade. If you're a clever futures trader, you can actually set that trade up and basically buy yen contracts short and go long on gold, and then one way or the other you should make some money. But I don't like those pair trades myself, but there's ways to set that up. Any play on your Fridays, they've all been killed like VLO. No, because it's not coming back. Oh, I just did a whole thing on that, Mike. We were just talking about that in chat, about gasoline. So this comment here. And, well, I don't, again, get into it again. But anyway, so right here in chat at 12:33, we were talking about that. And the bottom line is that cars are using less and less gasoline. Every month, they sell 1 million new cars that get much better mileage than the 1 million cars that are being traded in. And that's grinding the usage of gasoline down and down and down and down. Not good for the refiners. The only thing that's good for the refiners right now, and of course it's going to go up and down, but there's something called the crack spread, which is the difference of the price of the gasoline between the time they crack the barrel open and what they sell it for at the pump. So when the oil prices are heading lower and the gas prices are stable or going higher, that's great for the refiners. They have a better margin. Their crack spread is better. But when gasoline and oil are falling together, it doesn't help them at all. Their margin stays the same. But there does come a point at which oil, so what's been happening lately is oil has been climbing faster than gasoline. You can probably show that too. Energy. All right, so here's gasoline. It really hasn't gone anywhere, right? 155, blah, blah, blah. Oil is steadily a bit higher over this period of time, over the last quarter, which is what matters for earnings, right? So over the last quarter, oil's grinding up. Gasoline zigzagging, but generally is no better. In fact, it's right now worse off than it was then. So they're paying more for oil and selling their gasoline for less money. Bad, right? That's what's wrong with refiners. When that turns around, then it's a good time to look at refiners. Or if they bottom out to some ridiculous thing where, and that does happen, by the way, sometimes the crack spreads are bad, and when they're bad, people start extrapolating like, oh my God, they're going to make negative money, they're going to lose money every time they make gasoline. That doesn't last, okay? You wait till people overreact and then you go. But so far, there's nothing like an overreaction. It's just a downturn in a very cyclical company like Valero. And by the way, Valero is the only refiner I like. Oh, Sunoco. Sunoco is not so bad. Sunoco and Valero. Other refiners like Tesoro and things, I wouldn't touch them with a 10-foot pole. They don't have it together the same way. So we're back to the lows on Valero. They are starting to look attractive, but I really don't, I want to wait for this. I want to wait for my 42.50 to get back into a heavy position. All right, they certainly have been down around there before. There's no reason they won't go back down around there again. They're going to slump into the fall just like they always do. And that's when you want to pick them up. So even here with August, look where we went here. From July to August, look at that drop. So you'll know it. You'll see some capitulation here, and it'll be time to buy, but not right now. Oh, what happened to the Fed? Damn it, you guys didn't remind me. Oh, somebody probably reminded me. All right, so what? Oh, did anything happen? Did the markets move? That's why I didn't notice. No, nothing. All right. Well, as we expected, okay, like what are they going to say, right? FOMC. HTML. Ugh, too tedious, right? What do I care about? I care about where Tarullo, was Tarullo even a voting member? Oh, God, look at these minutes. So long. No, Tarullo doesn't even have a vote. Oh, there he is. No, voting for the action, Tarullo. Okay. So here's the thing. Tarullo moved the market today, right? But he already voted for no action. He already voted to keep rates steady. So there's no change. It's not like his vote shifted. It's his vote's what it was. All right, so we already know the Fed statement, and I'm really not in the mood, I got to tell you. Let's just see if we can get some highlights here. Developments. Developments, markets, middle period, largely response, nominal yields, forward man. Oh, God, really? Oh, that's a total situation. It's like incredibly boring. Okay. Pace of improvement in the labor market conditions slowed. Is that still true? Still true. Okay. GDP appears to be rising faster. That's gone. All right. So it's -1. No good. Consumer price inflation ran below committee's objective. Yes, true. In part, decreases of energy imports. Okay. No real change in energy prices since then. Survey-based measures long-run inflation were mixed in recent months. Still mixed. Market-based inflation declined. Not enough change to make a difference. Non-farm payroll gains slow, still slow. Unemployment rate still the same. Over the first 2 months, both the labor force participation and employment moved down on net. Okay, still the same. The share of workers employed. So the point of this is to figure out, has anything changed since this Fed meeting on June 15th? Okay, so what's changed in basically 3 weeks that would make you reinterpret these minutes? Measures labor compensation. Okay, compensation rate, no change there. Hourly compensation, blah, 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 nothing there. Okay. Unemployment rate for African, actually, I'm sorry, there is a change because the employee cost index actually went higher. There's a bit of inflation there, so that's another negative economic factors. So I have my fingers up, you can't see. I have 2 negative economic factors since the meeting. Unemployment rate for African Americans, okay, that's a little bit too much detail. All right, industrial production rose in April, not really, continuing but not really bad. Mining output contracted, that's getting better. Crude oil extraction continued pullback in coal production, not really changed. Manufacturing hours worked mostly declined in May. Okay, that's fine. There's still bearish there already. Automakers assembled mixed readings. That's actually not so bad. Such new orders. We looked at new orders today from national and regional pointed only subdued gains. That's true, only subdued gains. Growth in personal consumption appeared to be picking up in the second quarter. Yes, it did, but it was all on credit, so I don't consider that a good thing. So in other words, personal consumption went up, but so did consumer credit went up. And if they're buying everything on credit, I don't see it as being sustainable. PCE, apparent pickup in the PCE. Recent information, housing activity is broadly consistent. Housing has been so-so. Numbers have been okay. In April, average for first quarter building permit remained flat. Pace starts for multifamily moved up and faster. Sales of new and existing homes rose. Okay, no change there. Real project expenditures, business segment appears to be flat. Yep, and the previous quarter. So really, honestly, there's just no real changes here. Trade deficit narrowed substantially. That reversed. Sharp decline in that reversed. Sharp March data was revised. Deficit widened as imports reversed somewhat. Oh, in April they already saw that. So that's a nothing. Total consumer prices measured increased about 1%. Blah blah blah. Foreign GDP picked up. Okay, robust increase in Canada, Euro, Japan, Mexico. However, the pace of growth here is slow. That's now correct. Although some cases, likely temporary disruptions, they're not temporary. They seem to be longer term. No word about the Brexit. In the United Kingdom, okay, uncertainty about the outcome of the referendum exit from the EU seem to be holding down investment. Boy, they didn't know they had to, right? In contrast, indicators for emerging Asia and China suggested economic growth picked up in the second quarter. I don't know if that's really true. Inflation remained low and advanced, blah, blah, blah. Okay, so effectively things are a little bit more bearish than they were 3 weeks ago. Some of that, you can blame Brexit for some of that, but overall, the overall situation is generally bearish. So that means that this is nothing, and the market is reacting correctly. There's nothing here. It's what the Fed thinks it was. There's no change, and their policy statement stands. It's not more. We're not more bullish or less bullish than it was in that policy statement. So therefore, all these levels, and if you go back to June 15th, where were we on June 15th? Probably right where we are. So where were we June 15th? Yeah, there, 2050. So we were basically just about where we are at the time. There's no reason to be more bullish. The reaction we had there was we went up to 2100 because the Fed was staying on hold, and then we collapsed from the Brexit. So now we're back in the same area. The Fed's still on hold. The Brexit still happened, and we're going to drift along. That's it. Not exciting. So NJ played BB. Is the EWJ trade still attractive at $1.03 net debit? I suppose not, since it's 5% premium's gone. No, absolutely not. No, obviously you don't want to play because there's a good chance that that's all you're going to get out of the thing is $1. So if you're paying more than 95, it's not worth doing. So doubt they can raise rates. I don't see how they can raise rates. I really don't. I mean, everyone's stuck, and it's really tough to dig out of this 0% thing. I mean, because when you raise rates from 3% to 4%, that's a 30% increase in rates, and that sucks. But people can deal with a 30% increase in rates. When you raise rates from 0.25% to 1%, that's a 300% increase in the rates. That means you have to allocate 300% more money to pay interest than you had. That's shocking. 30% more money sucks. 300% more money, shocking. It's a big, deep hole they've dug for themselves with this crap. GN is gold to yen ETF. Oh, I didn't know they had such a thing. Thanks, Latch. Really? I got to wait. What's that look like? Oh, I'm sure it's a ripoff. You know, a specialty ETF. GEN. I had never heard of it. All right. Advisors share gold in yen ETF. I like it. Does that have options? I mean, I don't know what their costs. I'm sure their costs are horrendous. GYEN. No options. Ah, sad. Sad, sad. Wow. Oh, I like it. I like it. I like this $12 line. If it had options, if it had options, I would play because I would say this 12 line is going to hold. And it's interesting to see what happened. A lot of people, even though gold hasn't moved much compared to the yen, a lot of people seem to have been betting on the ETF because the ETF has made like a 5% move. Even though gold in yen hasn't made a 5% move, a lot of people are doing what I was thinking, which is putting this betting on this ETF. That's interesting. And look at that spike. Very interesting. Okay. I had never heard of this thing. But there's like an ETF to everything. It's really crazy. Andy says, do you still like selling the FCX puts? Maybe the 8th. Let's take a look. FCX. See, I like them down here. So it's really hard for me to say I like them here too. I still like Freeport, but they're 60% copper. I keep thinking infrastructure. I keep thinking there'll be infrastructure stimulus, but we haven't seen it yet. They've got a bunch of gold. In fact, here, let's take a look. You know, when you're in Thinkorswim, if it's a big company, a lot of times there's this profile, right? And the profile tells you some good stuff. So, in fact, here you go. Here's copper, 60%, oil and gas, 23%, very little gold. So gold's not a big part of what they have, and they're not efficient miners. That's the other thing, though. They're not like Barrett. They don't have like incredibly low cost of gold. So they get less leverage. But I did like them because, because it was just so silly. The price of copper at the time, the price of gold at the time was just so silly that it was worth playing, even though I still don't like oil and gas. So no, I actually find, after all that, I have to say no, I don't really like them at 1075, and I'm not sure if I can get there. No. All right, yeah. These I would do. See this 95 cents? If you can get 95 cents for selling the 550 puts, that's right back where we were. That's back down to the net 450 or net whatever, so I would do that. I wouldn't do this. I don't think, 6 is risky. If you can sell these for 190, it's a little riskier, but I don't mind it. But this trade's got to be really efficient. Let's see. If we sell 85 cents, is that what I said? All right, well, let's say it's 85 cents. If we sell at 85 cents, and let's say we sell 100 of those. Now remember, if I have 100, I have to buy 10,000 for, what's the price? 550, right? So I have to buy 10,000 for 550. I'm going to collect $8,500. So my maximum loss is $46,500. It's only using here's what I like about it though. I'm only using $5,000 of buying power. So if you really, in your portfolio, and it's obviously proportional, but if your portfolio doesn't mind owning $46,000 worth of FCX, having 10,000 shares of Freeport at net 465, then you can make a promise to do that. You can collect $8,500 in cash, and you'll have a net margin effect of only $5,000. and all Freeport has to do is hold 550 into January of 2008, so for 18 months, and you make $8,500 free and clear. So that I like. I don't like playing them bullish from 1075. I think they could easily go back to 8. I don't think it's likely they go back below 6. So I don't mind this one either. This isn't too bad. And you can obviously do a much more reasonable amount of those if you want to sell. Let's say you just do 1,000, right? So you sell those. And we go to 185. So now you're going to collect that. And we'll only do 10. So here you're going to collect $2,000, $1,850. You got a $700. Look how efficient that is. $700 of buying power. That's way more efficient margin-wise. But you're taking more risk because you got to be at 8. This one you only have to be at 550. This thing can drop 50%. And you still make money. So here you got to hold 8, but you're collecting $1,850 for only promising to own 1,000 shares at net $615. So you're promising to have $6,000. You're collecting 1/3 of what you're promising to own up front. So, if you have a small portfolio, I would play it that way. And if you have a large portfolio, then the other way is like free money. So that's two ways to play. But if I was a smaller portfolio, I'd go for this because, first of all, it uses less margin. You don't have to make a very big commitment. I'm only committing to own 6,000, and you're still collecting $1,800 for your 6,000 commitment. The reason I like the 550 better is because I really feel much more comfortable having the 550 target. I think 8 might come into play. And it doesn't matter, you're good until 615, but I just prefer to actually, I like to make my 100%. That's just my head, okay? I like to make my 100%. And again, if you don't need the margin, it wasn't using margin, but the point being, if you don't need the margin, like in a long-term portfolio, you don't need the margin, then why not? It's like it's just sitting there doing nothing. So why not pick up $8,000 for promising to buy Freeport McNamara if it gets really cheap again? That's not a hard thing to do. It's like let's say you looked at a house in 2005, and the house was $400,000, and now it's $1 million, right? And somebody says to you, "Hey, I tell you what, I'll give you $20,000 if you promise to buy that house for $400,000." And you're like, "What? You want me to buy that $1 million house for $400,000?" They're like, "Yeah, I'll give you $20,000, and you promise that you'll buy the house from me between now and 2018." And now you think of that. Now you think about that, and you say, think about a house that you actually would have wanted to buy that you regret not buying, and you think about that offer. And you say, okay, so if it goes back to the 2005 price, you'll make me buy it. You'll make me buy the $1 million house for $400,000, but you'll give me $20,000 now to make you that promise. And it's like, why wouldn't you do it? The only reason you wouldn't do it is if you think, like, I don't have $400,000 and I'll violate some agreement or something like that. There's no other reason not to do it. If you want, and again, if you actually want a house and you think you'd like that one, there'd be no reason at all not to do it. That's how I look at these things, okay? If you know what the value of something is, then you look at these trades and say, why would I not do that? So with the FCX, that's what I'm saying, at 550, when I'm netting in at like 4, whatever the hell, when I'm netting in at 480 or whatever it is, why would I not do that? Of course I want to buy Freeport for 480. I would love to have 100,000 shares of Freeport, 10,000 shares, whatever it was, at 480. I would love that. It's freaking $10 now. So it's an obvious trade. That's what I'm saying. So that's what I mean by wanting to buy something. And again, I'll be considering that now because if I need some free money to make a spread, when I do a hedge, I like to buy the hedge, and I like to offset it with something I'm willing to buy cheaply. This is a nice offset. We can easily, without thinking about it, pick up $2,000 here because of course, well, here it is. I mean, it's $2,000. So so in a spread, I'm collecting $1,850. I'm promising, my worst case is I'm promising to buy $6,000 worth of Freeport. which I totally don't mind owning. But I'm collecting $18.50 in free money, and I'm not using any margin. $600 in margin, $700 in margin. So that's a perfect offset to a hedge. So in other words, I take something like that SDS spread we talked about yesterday in the top trade alert. You take that spread, and if I want to raise $2,000 to offset it, I sell these puts, and I've got the money. And so what's my possibility? Well, if the S&P goes up and makes my spread worthless, my SDS spread, then it's unlikely Freeport went down significantly because the S&P is doing well. If the S&P goes down and Freeport goes down, my worst case, well, I'll get paid on my SDS spread. And my worst case is I own $6,000 worth of Freeport, which in a $100,000 portfolio isn't a big deal. It's probably not going to be zero, so maybe I'll lose $1,000, $2,000. But meanwhile, I had a free hedge. So this is what you would call a perfect offset for a hedge. It's a great, great trade. So isn't that funny? Because actually we kind of went in a circle on that. It's like I don't like it at that price, but since you can get it for such an incredibly great price by discounting yourself selling options, I do like it. What's going on here? VLO. Thanks to VLO's comments, I was wanting to increase my position to butterfly at the fall was exactly what I needed to. Yeah, okay. What price do you see UNG at the end of the year? I say $3 and $4 next year, okay? So if you want to know, that's where we're looking at. 12. Oh, UNG, I'm sorry, I'm talking about the gas. All right, so UNG. I'm talking about the actual gas itself. 12 sounds a bit aggressive. No, we're close to $3 now, so $3 is like 9, and then from 3 to 4 is 33% more, right? So, oh, you're right, 12, okay. No, wait, no. Okay, 3 to 4 is plus 33%. Yeah, no, 12, you're right, yeah, 12. Seems a little high, but it's actually quite reasonable. Okay, so at the end of 2018, I think 12 is kind of reasonable. January Trees. I don't read him. Any thoughts on BHP? No, I like BHP. Obviously, back into a rough patch for the energy sector. But, oh no, I'm thinking BHP. Damn it. I don't follow BHP. I think there's decent value here, but I'm not a big... I don't pay attention to them daily. They have a nice dividend. Why do they have no earnings? Their forward PE is 30. Nah. What's going on with these guys? No, I don't know why this is. Look at that, 27 cents here, 82 cents next year's estimate. They're followed wisely, of course, because they're a big company. How many analysts are there? Where the hell is this thing? Oh, they're not. Oh, wait. Whoa. What is... That's so weird. I would like to read what this guy said. I don't know who it is, but I would like to... Oh, it's JP Morgan. Oh, from underweight to neutral. How nice. I would like to read that JP Morgan report. And it just came out today, apparently. So maybe you read it, and that's why you're saying it. He flipped. It's a very undercovered for such a big, for a $75 billion company. That's crazy. They only have 5 analysts covering them, for one thing. He flipped from hold to buy. And he did it today. He must have had some reason. Obviously they're capable of earning money. The revenues are there. So here they earned, wait, That doesn't make any sense. Oh, it does. Okay, last year they earned 267. This year they're going to earn nothing. What happened this year? No quarterlies. Ugh, that's a big investigation. Okay, ask me in chat on the weekend. I'll be happy to look it over. I'm very interested into what's going on with these guys. I don't know that they're undervalued. I don't know they're overvalued. I don't know what's going on with them. But that's a very odd situation, and they are nice and they are getting cheap. So I assume that some of this is reflected. They're not as cheap as they were, though. And I need to find out why and what's going on. I'm very, very interested in why the JPM guy flipped on them. I want to know what his logic is, too. No, BHP, they do a lot of stuff. I don't know what they... Oh, well, I mean, let's go back to that. Let's see if they have a breakdown for them in the analysis. Yep, company profile. Oh, no, that's not BHP. BHP. Ah, no profile. Damn it. Then you go to Analyze, which isn't as good. Look at the fundamentals. No, not fundamentals. Wait. Oh, yeah. I have to type it in. BHP. There's a lot of questions on this. See, this is crappy information. It's way better when they have a proper profile. Wow, it's a puzzler. I mean, thank you. I love puzzles, but I don't know why. I don't know what's going on with them. I don't pay enough attention. That's really interesting, though. Numbers are all messed up to their big spin-off. Yeah, so maybe they spun off all the good stuff. Maybe it's not worth it. You know, and see, that's the thing. What are we really buying? What's the earning capability of the new stock, so on and so forth? All right. Well, yeah, and well, I don't care how many tickers they have. I want to know what is included under this particular BHP ticker and how are they doing. So Latchad says it's a bad bet and they're poorly managed, and I don't know. I mean, again, though, I like infrastructure. I do like infrastructure going forward. I think there's a future in it, but I don't know what this leftover bit of BHP does. So there's a lot of research to go into something like that. They have an OG sector that might be bleeding their cash at these oil prices. Yeah, that makes sense too. But will it stop? Because these oil prices aren't going to change. I don't think something's going to change too much. They mine down deepwater LNG projects. Oh, forget that. Oh. Okay, that's a killer. If that's going on, then forget it. Because that deep water is going to be a long, long time before it comes back. And look at that. It's 10-3. Holy cow. Time flies, kids. I'm going to have to wrap this up. They built a ton of LNG facilities at the wrong time. Not really the wrong time. That stuff's just going to start to kick off, but it depends on what they spent and if they overspent and so on and so forth. And what do you mean they built it? They built it with their money? But when you say they built it, they get paid to build these things. Did they take their own money and invest this stuff? Is that what you're saying they did? Because they're not supposed to do that. They're supposed to get a contract to build something and build it. But of course, somebody could have not paid their contract. Somebody could have contracted them and whatever. So that's interesting. All right, if you guys want me to look at it, I'd be happy to look at that over the weekend because that's kind of interesting to me. But Chevron, right? Oh God, that was expensive. Yeah, but Chevron pays their bills. What does BHP care? They don't care if it works or not. They're like, you want an LNG plant? Here's an LNG plant. After that, it's not their problem. I mean, the only thing is that they're counting on a contract for go-forward operations, and they mothball it. And LNG keeps leaking. Well, that's bad. Now, if they constructed it poorly, that's not good. In fact, that's really bad because then they won't get any other contracts. That would be crappy because we certainly constructed LNG plants that are working perfectly. So it's very bad on them if they've done a bad job putting it together. Very interesting. Sounds well worth the checking out. All right, how the market's looking. Very boring today. Sorry, nothing exciting to trade today. Nope. Boring, 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 boring. I mean, look, my vibe is still this and the last thing I'm talking about. Let's talk about that top trade. Very expensive LNG versus U.S. shale LNG. Oh, that's no good. Well, that's stupid too, isn't it? Then why would they do it? What's wrong with Chevron? Why would they do that? It annoys me when big companies make giant mistakes like that. Top trade, right. So you can always check out top trades by going there. Unless, of course, you're logged out, then you got to get back in. There we go. Got to be a member to see top trade. All right. So yesterday our top trade was SDS, and we used Ford for an offset. This is what I mean, though. We used Ford, and you could just as easily have sold 20 of the, what were they, 1850? So you could have sold 20 of the FCXs, and that would have been 20 of the FCX $8 puts, and you would have gotten $3,600 or whatever, or yeah, about $3,600, $3,700 instead of 32. And I probably do like that offset better. But this is the most important spread because the SDS 60, I'm sure this is cheaping out. It was the September 16 calls, 210, sell the August 18 calls for 75. Let's see what those prices are now. 16, 18. Well, that's a clever trade. Who came up with that? I like that. There's so many good reasons that's a good trade. So you're buying the low theta, in other words, the time decay, on the September 16th, because you have 72 days. They're in the money, and they only cost $1.90. All right? So that's the September 16th. Then you're selling the August 18s, which are now 62 cents. So it's 191 minus 62. Is that better than before, or it's about the same? 191 minus 62 is 129. And how much was this? This was 210 minus 75, 135. Ah, so it got cheaper today. Okay, it should have gotten cheaper because it went the wrong way. All right, so you can still do this trade for easily, it's basically $1.30, let's say. And then you have then you have to find an offset. Now the offset doesn't have to cover the whole thing, but if you do $54.30, your cost is $6,500, right? $1.30, 15, yeah. So you're $6,500 in at $1.30, and then you just want to do a partial offset. And ideally, yeah, I like the the FCXs or these Fords. Either way, you sell these things for about $3,000. So then you're in the trade for about $3,500 or less. Okay, and now you have 50 spreads. They're $10,000 because SDS is still, well, it's still basically 18. So they are like $10,000 in the money, and you spend $3,500. So the only way you don't make money is if the S&P goes higher. Now, if the S&P is going higher than your insurance policy, you don't need it because it didn't pay off. You have a $3,500 insurance policy that pays you $10,000 back if the S&P goes up. Now, if the S&P, now think about this though. Here's the cool part about this trade. If the S&P for the next week stays down around 18, these expire worthless. Then you get to sell another group of these of the August for $3,700. If you can get $3,000 more, you have a free spread, and the only thing you have is the obligation on the put side. But otherwise, you have a completely free insurance play, $10,000 of free portfolio protection if the S&P stays down. If it doesn't stay down, then of course you're going to get your insurance money. You're going to collect, if the S&P doesn't go lower, you will collect $10,000. If the S&P does go lower, you will then have your short calls expire worthless, and you can sell short September calls. All right, and right now the September 18 calls are probably more than that. The September 18 calls are 85 cents. So more than the August, of course. So in a week, the August expire worthless, You sell the September 18 calls, you pick up another 85 cents, that covers the rest of your money, and now you've got net no cash and you still have a hedge. How great is that? Okay, that's why it's a top trade. Fantastic play, brilliantly designed. That's how I like to hedge. You're in the money now, and the only way the spread doesn't make money is if the S&P goes higher. If the S&P goes higher, then it's very unlikely that my short puts are going to put me in trouble because I'm taking a nice blue chippy company like Ford or FCX or whatever. You pick a nice company that you actually want to own for the net. So Ford for net $10, I sure as hell want to own 2,000 shares of Ford for $10. I got no problem with that. So free insurance, that's what this is. Nothing better than free insurance. All right, and that's going to have to wrap it up. I'll check one more question, if there is such a thing. Yeah, all gas, my theory on gas is all gas will be $4 in about 2 years. That worldwide gas will drift down to about $4. As the LNG moves more and more, it'll just become a flat thing like oil is. You know, basically oil is kind of the same everywhere. Be sure to write up FCX on chat. Oh, okay. I mean, it's not official trade, but remind me in chat, and I'll write it up in chat. Sell Netflix, what? Wait. Sell short Netflix puts. Under no circumstances would I be bullish on Netflix, so that doesn't sound right. Would you short TF, the Russell? Here, and no, I would stick with the I would stick with the S&P. As you get close to 2,000, I mean 2,100 is an easy stop line. If I'm going to short the S&P. I would short the NASDAQ up at 4450 and 17,850. You can short the Dow, and these are your confirm lines: 17,850, 2,100. 4450 and 1150. Those would be your shorting lines. Basically, these red lines. So if we get to there, you want to short the one that goes down. You know, if they go down, if 3 of them go down, then you want to short the 4th one as it goes down, right? And you can even look at the Nikkei here at 15.4, would also be in the same group. Okay, and as I said, if they all go over their red lines, then the Nikkei makes a good long at 15.4, and you then wait, and as long as they are all over, this guy's in good shape. All right, but again, it's nothing I'd be enthusiastic about, but you know, if for whatever reason we spike up tomorrow based on the Fed statement or based on Hills and Rath's interpretation of the Fed statement, I would certainly then short because it's the same crap over and over again that we always have. All right, and now I really do have to wrap it up. Thank you so much for coming, everybody. It's been so much fun, and we will do it again next week. Take care, folks.